Hey everyone, my name is Adam. I'm the editor of The Fifth Person, and we're an award-winning investment site that focuses on equity in Singapore, Malaysia, Hong Kong, and the US. And in this video, we're going to talk about how we can invest our CPF money in shares. All right. So the thing is, when it comes to your CPF, it's something that you want to protect and be very conservative about, because this is money that is going to be there that you're going to need when you retire in your golden years. All right. So the thing is, how do you pick the right type of companies to invest in to make sure that they grow safely and consistently over the long term? So today in this video, we're going to cover a few topics. So we're going to cover how you can open a CPF investment account for yourself, how much you can set aside for investments, what type of companies you should be looking for if you're going to invest using your CPF money, and of course, when is the best time to invest as well. So if you're ready, let's go right into the video. All right, in this video, we're going to talk about how to invest your CPF prudently and profitably. So it's not just about chasing the highest returns possible when you're investing your CPF money. Because your CPF money is meant for your retirement, you want to make sure that you're extra careful and conservative with it. So you want to invest very prudently as well. You want to reduce your risk and only invest in the best high-quality companies that allow you to earn a consistent return over the long term. You don't want to take bets with your CPF money, all right? So just to recap, we have 3 accounts in our CPF. We have our ordinary account, the OA, the special account, the SA, and the MediSave account, all right? So the ordinary account earns 2.5% interest, all right? And the special account earns 4% interest, all right? So the thing is, if you're able to take your CPF money and invest in the stock market, and if you do it well, you should be able to beat the 4% interest in the special account, all right? Because the stock market is a place where you can invest in companies with more potential growth that are able to perform well, and that will allow you to earn maybe 10%, 15% returns on your money if you invest correctly. All right. But the thing is, if you don't do it right, then you might as well just not invest and take that risk and just put your money in the SA and earn that 4% interest. All right. So the question is, how do you pick the right companies? How do you pick companies that will not expose you to too much risk? So that's the point of this video. So the thing is, if you want to invest using your CPF money, the CPF has something called the CPF Investment Scheme, or CPF-IS, which allows members like you and me to invest our CPF savings in instruments like unit trusts, fixed deposits, bonds, and shares. All right. So for the purpose of this video, we're just gonna cover CPF-IS for your ordinary account and using that to invest in shares. Okay. Now, the CPF has been tracking the returns of people who use the CPF OA for investments. All right. So in FY 2018, you can see here on this chart that 38% of members who used their money for investments made more than 2.5% interest. So they beat the ordinary account interest. All right. But then there are 26% who only made less or equal to the 2.5%. And then there are still some people who made losses. So this goes back to the point. If you're going to invest using your CPF, you have to be very careful with this, because if you're going to lose money, or if you can't even beat 2.5%, then you might as well not do anything and expose yourself to the extra risk and just put your money in the CPF and earn the interest risk-free. All right. So CPF has been keeping track since 2015. So cumulatively, from 2015 to 2018, 60% of members have made more than 2.5%. But then again, you still see some people making less than that or equal to 2.5%, and some of them still lose money. So you want to make sure that if you're going to invest, make sure you do it right. Now, the first step is you want to find out how much you can invest if you want to use your CPF to invest in the stock market. All right. So there are a few things you need to be. You need to be at least 18 years old and you're not a bankrupt. You need to set aside at least $20,000 in your OA. And on top of that, you can only invest up to 35% of your investable savings. So I'm just going to give you an example of how we get these figures. Okay. So let's just say, for example, you have $50,000 in your ordinary account. You need to set aside $20,000, so that becomes $30,000. That's your available balance. All right. On top of that, you have a 35% limit on your investable savings. So your investable savings refer to your OA balance and the amount of CPF you've withdrawn previously for investments or education. So if you've not invested using your CPF before, your investable savings should be the same as your ordinary account. So in this example, it will be also $50,000, and that 35% limit would mean $17,500. Now, the CPF is going to take the lower of the two and use that as the limit that you can invest using in shares. All right. So in this case, it's going to be $17,500. Now, not to worry if you don't know how to calculate all this. All you need to do is you go to the CPF website. You can log in using your SingPass. You can go to view my statement, and the CPF will tell you exactly what is your limit that you can set aside for investments in shares. All right. So you don't have to do it yourself. CPF has already calculated this for you. You just got to log in and have a look. Okay. Now, the next step is you have to open a CPF investment account. All right. So you can only open a CPF investment account with a Singapore bank. So DBS, OCBC, or UOB. All you need to do is you can go online. You can fill out the form and open a CPFIS account online. Or if you want to, you can go down to a branch and look for a representative there. They will help you open the account as well. Okay. Now, once your account is approved, the bank will give you a CPFIS account number, and you need to notify your brokerage of this number. Okay, so once you let your broker know about your CPFIS account number, they will do the link for you. They will link up your brokerage account with your CPFIS account number. Okay, and then once it's linked, and if you want to buy shares using your CPF, make sure you choose the CPF payment option before you make a trade, because if you don't do this, then you just gonna have to use the regular way, which is basically using cash. All right. So for example, on this trading screen, if you want to make payment using CPF, make sure you choose CPF right here, and then the broker will know that for this trade, you intend to use your CPF as payment and not cash. Okay. Or alternatively, you can, if you're the type that texts or calls your broker, you can also let them know that you want to use CPF in advance of the trade as well. All right, so there are some charges for using your CPFIS. It's $2.50 per 1,000 shares or part thereof, and then $2 per counter per quarter. UOB is slightly cheaper at $2 per 1,000 shares. It's more or less the same. So these are fees on top of the regular broker commissions that you pay as well. It's not a lot, but just to make sure, just to let you know that there are charges using CPFIS as well. All right, so all three banks are more or less the same. Just go with anyone that is most convenient for you. Now, the third step is that you want to invest only in high quality companies. So this is a very, very important step, because once again, your CPF money is for your retirement. You don't want to gamble with this. You only want to invest in the best companies, and not take any extra risk with that. Okay. So if you go to the SGX website, okay, they will have a list of CPF approved stocks. All right. There are over 400 right now. And you can go there and you can scroll down and you'll see a whole list of stocks that you can invest using your CPF money. Now, the thing is, just because it's CPF approved, it doesn't necessarily mean it's a good stock. It just means it's approved by the CPF to be, that you can use your CPF money to buy that stock. That's it. Okay. It doesn't mean that you don't know anything about its financial performance, about its debts, debt ratio, and all sorts of things. All right. So you don't make the mistake thinking that it's a good stock. Okay. Now, what does it mean to be CPF approved? It only means that the company has to fulfill these 5 criteria, and that's it. Is that it's incorporated in Singapore, it's listed on the SGX or the Catalyst, it's traded in Singapore dollars, it allows shareholders to attend the general meetings, and it's not on the SGX watch list. Okay, so that's it. So these are the criteria that a company needs to fulfill to be CPF approved. That's it. You don't know anything about the quality or the health of the company. So once again, don't make the mistake of thinking that if it's approved, it means it's great. Okay. Now, we are looking for 6 things in general when you want to use your CPF money to invest. All right. First one is you want to invest in a mature, stable company. So you want to invest in a company that's been around a long time. You don't want to invest in a startup that's potentially high growth but high risk as well, because you want to make sure this is your retirement money. You want to invest in something that's mature and stable. In other words, like your blue chip companies. All right. You want to invest in a company that has a high quality, resilient business model. So whether rain or shine, whether there's a recession or not, this business will continue to generate income, revenue, because it's very resilient. You need the services and goods that this business provides. Okay. Most of the time, they're industry leaders as well. So they dominate their niche. They have good market share, and they have competitive advantages over the rest of the peers. Okay. They're able to generate recurring revenues and cash flow. So in other words, they're non-cyclical. So company will be something in the oil and gas industry that's affected by oil prices. It goes up, it goes down. That affects the profits of a company in the oil and gas industry. So you don't want to invest your CPF money in something like that because it's very volatile. You don't want to take that sort of risk. So you want to invest in something a company that's able to generate recurring, stable revenues at all times. You also want to make sure that a company pays you a steady dividend. The reason why we demand a dividend is because a dividend is something that you will receive every single year, almost without fail. And it's the same with your CPF, because every single year you will earn 4% from your special account. So if you're going to invest using your CPF, you want to make sure that you're going to receive a return every single year as well, instead of relying on a company to grow using capital gains, because that's unpredictable. You don't know what's going to happen with the stock prices down the line. You want to make sure you invest in a company that's paying a steady dividend so you can earn a return every single year, just like your CPF. And of course, if you're going to earn a dividend, you want to make sure that you're making at least 4% or more. Because if you're not making 4% or more, you might as well put your money in your special account, which will pay you 4% guaranteed risk-free. So no point investing in a stock that pays you a 2% yield when you can earn much more just putting your money, transferring it from your OA to your SA that earns you 4% every single year. Okay? So just to give you some examples, in some industries and some companies in Singapore, we should potentially look at that fulfill some of all of these criteria, or some of these criteria. All right, so Singapore banks, they're pretty good banks. They're one of the most some of the strongest banks in the world. They're very well capitalized, and you can consider looking at the Singapore banks as well. So we all know they are blue chip companies. They're high quality banks. They have a resilient business model. They're slightly affected by the economy, but overall they're pretty resilient in Singapore. They're the industry leaders. There are no other banks. There are other banks, but these are the only 3 local banks that you have in Singapore. They earn very recurring cash flow. They pay a steady dividend. And of course, whether or not you earn a 4% yield depends on when you invest in that, which I'll cover in my next point. Okay. You can also take a look at testing and inspection like Vicom, because this is in an industry where all of us are required by law to go inspect our vehicles, whether we like it or not. So because of that, Vicom earns a very stable recurring revenue every single year. Okay. They are also the industry leader. All right. They pay a steady dividend, and this is something you could look at as well. Okay, another one will be airport services. So SATs, they handle all the ground handling services, baggage, in-flight catering as well. So even though airlines can be a volatile business because of oil prices, the companies that run the airports and help to support the airlines are very resilient, because you always need the services no matter what to operate the airport, to run, to make sure the airplanes can fly. All right, so something like SATs is very resilient. They're also the market leader in Singapore. They pay a steady dividend. They earn recurring revenues and cash flow. All right. Same for SGX. They're the only exchange in Singapore. It's basically a monopoly. And of course, medical is also a really good industry to look at, because whether we like it or not, recession or not, if we're sick, we need to go look for the doctor. And sometimes you can't go to a doctor and ask for a discount just because it's a recession. All right. So medical is generally considered a very resilient industry as well. All right. So these are just some examples. I'm not saying, I just want to make a disclaimer right now. I'm not saying that you should, there's no recommendation to buy or sell any of these shares right now. It's just for educational purposes. But I'm just saying that if you want to take a look at stable companies, these are some of the companies you can consider doing research on. And these are some of the industries that are considered more stable in general. Okay. Now, we're going to have a look at SATs, because I know I'm just giving you some points, but I want to drill it down a little bit deeper so you have a bit more color on what I mean. So let's have a look at SATs. All right. So for SATs, they provide ground handling services. Like I said, they do baggage, they do security, they do the warehousing, and they also do the in-flight catering, right, for airlines around Asia. Okay. So they were founded in 1972. They've been around for a long time. They're a mature, stable company, and they are a market leader as well. Okay. So they're in over 60 locations in Asia, including, of course, Changi Airport. And in Changi Airport, they control about 80% of the ground handling and catering business in Singapore, Changi Airport. So in that sense, they're like a monopoly within Singapore. And if you take a look at their revenue, is very stable and consistent. It's about 1.7 billion to 1.8 billion in 2019. and the profit is now at 248 million. So they earn about 200 over million every single year. It's relatively stable. You would expect that from a company like SATS. If you take a look at their cash flow, their free cash flow goes between 175 million to about 220 million free cash flow as well. So it's roughly in line with their profit as well. And then, of course, free cash flow is important because you need to use that to pay dividends to shareholders like you and me. Now, if you take a look at the revenue by geography, all right, so most of the revenue comes from Singapore, which is what we want to see because we know they have a monopoly, I would say a monopolistic position in Singapore. Okay, so it's good to see that 80% of revenue comes from there, and it's revenue that's protected within the Singapore market because they have a very strong dominant position right here. So most of the revenue comes from here. It gives you more visibility that this is going to be stable down the line. And of course, if you take a look at the dividend per share, it's very, very consistent. It's been growing every single year from 14 cents per share in 2015 to 19 cents per share in 2019. So this is for ordinary dividend, and it's very steady. If you want to see something like that, if you're going to invest in dividend paying companies, all right, for your CPF. All right. So if you take a look at this at 19 cents per share, what is the yield? Because remember, once again, we want to make sure that we can beat 4% that we can get from our special account. So if you take 19 cents per share, and as of when I'm recording this video, SATS is about $5.08. All right. So if you take that if you do the calculations, the yield is about 3.74%. So not quite good enough to beat the 4%. So in this case, I really wouldn't use my CPF to invest in SATS right now, for example, because I wouldn't be able to beat 4%. Okay. So I will wait for a better time where I can get a higher yield. All right. So when does that happen? That goes into our last point, which is about investing during a market crash. Okay. Now, a market crash is some of the best times you can have a look at shares at great companies anyway, because that's when prices are depressed. You get a really good price, you get a higher yield. Right. Well, just take a look at this chart of the Straits Times Index over the last 10 years. So the Straits Times Index is a basket of the 30 biggest companies in Singapore. And over the last 10 years, you will notice that there have been 4 crashes. So the first one was the Great Recession, the big one. In 2008, 2009, we had the Euro debt crisis in 2011. We had the China stock market crash in 2015, which affected us. And we had the US-China trade war much more recently in 2018, all the way up to 2019, thereabouts. Okay. So we have 4 crashes. We have had 4 opportunities to have a look at shares at this times. All right. So if I superimpose these events onto SATS, all right, and in 2009, the yield for SATS was 9%, which was incredible. All right. So 9% obviously is a lot higher than 4%. And if you had invested in SATS, then you would have been sitting on really, really good gains, as a lot of companies invested right there and then. All right. But then again, if you missed that, there was the Euro debt crisis in 2011, which would have given you a yield of 5.3%, which again beats the 4% that you earn in your SA. In 2015, it was 3.9%, 3.94%, and then recently in 2018, December, it was 3.92%. So not quite 4%, but almost there. Again, it's up to you if at this point whether you want to invest in CPF, using your CPF money into a company like SATS. But then again, that will depend on whether you're okay with the extra risk that you're going to take, because you're going to earn about mostly the same dividend, but you have the potential for capital gains as well. Okay, so it's really up to you. I would consider it at that point in time, but that's really depends on your risk appetite and all that as well. All right, so just to give you another example, this is DBS as well. So DBS Bank is this for market crashes. You see the yields have all beat the 4% special account interest. All right, so in the Great Recession, it was a 9.4%. In 2011, it was 4.8%, and then 2015, 4.6%, and then recently, with the US-China trade war, it was at 4%. So at these points, you could have invested in DBS and earned a 4% and above yield that would have beat the CPF special account interest. So once again, if you want to invest, these are the best times to invest in a great company. All right. So in fact, if you had a look at the Singapore banks during the trade war in December, which is still going on actually, but there was a window during December 2018 to June 2019 where the banks in Singapore had their price come down, which meant that the yield went up. So for like DBS, it almost hit 5% yield in June, and for OCBC and UOB, it crossed the 4% mark. So if you had used your CPF to invest in the banks, which are some of the strongest banks in the world, and earned at 4%, this would have been an option if you wanted to invest using your CPF money. Okay, so once again, not a recommendation, but this is a consideration you can look at when prices come down, especially for great companies like our 3 local banks. So once again, just to summarize, if you want to invest using your CPF money, the first step is to find out how much you can invest. You can always go to the CPF website to find out. And then you need to open a CPF investment account. Just go to one of the 3 local banks and open a CPF account, link it with your brokerage account. And then steps 3 and 4 are the most important. If you're going to use your CPF money to invest, make sure you only invest in high quality companies that are mature, stable, and pay you recurring stable dividend. And you want to make sure that if you want to invest, make sure you invest during a market crash, because that's when that's the best time to earn the highest yields and the highest returns potentially. And you can beat the 4% benchmark that the special account interest pays you. Because if you can't get that, you might as well just put the money in the special account. And once again, you want to make sure that you earn a 4% from your dividend, because you don't want to rely on capital gains. All right, you want to make sure that you can earn that interest every single year. So make sure you look out for very stable, high quality dividend paying companies.
Alright, so I hope you found this video really useful. So if you're interested in finding out more about great dividend companies that can pay you a growing dividend over time, and at the same time give you capital gains, you can subscribe or register for our free training webcast called The Income Strategy. So you can find the link in the description below. It's over 60 minutes of video content, and it's going to help you give you the strategies to help you find all these really great dividend companies as well. So once again, if you really enjoyed this video, please hit the like button, and of course share this with your friends, and of course subscribe to our channel for more videos and updates. Thanks for watching, and I hope to see you in the next video.